Hey everyone, welcome back to Corporate Decoder, where we look at company reports and figure out, well, let's just say some funny things happen when you exchange big piles of debt for company shares. Today we're diving into a filing from Seagate Technology Holdings PLC, and it's all about a recent deal they closed that has some interesting financial moves. Let's see what they're up to. So, Seagate, you know them. They make hard drives and storage solutions. They're a big name in tech. Now, what is happening here is that on the 10th of November, they wrapped up a pretty significant transaction. They basically swapped out a bunch of their debt for their own company stock. Think of it like this: they had some exchangeable senior notes. That is basically a fancy way of saying debt that could be turned into shares, and they decided to buy a lot of those notes back. This whole deal involved close to $500 million worth of these notes. Instead of just paying cash to get rid of this debt, they offered a mix of cash and their own ordinary shares. In the end, they gave out about $503.4 million in cash and a little over 4.3 million ordinary shares. Now, this isn't some crazy public sale of shares. They actually did this through private deals, meaning they talked directly with a select group of investors who held these notes. The company is saying they did this by using an exemption in the law, which basically means they didn't have to register these shares in the same way they would for a regular public stock offering. These exchanges, as they're calling them, wrapped up right in the middle of November. It's important to note how they decided on the share price. They averaged the stock price over a specific trading day, the 5th of November. This is a common way to set the exchange rate in these kinds of deals to make sure it's fair for both sides. But it can also mean the actual shares issued can shift a bit depending on how the market is behaving on that particular day. What is really interesting to consider here is the why behind this move. When a company buys back its own debt, especially debt that can turn into stock, it can signal a few things. On one hand, they might believe their stock is a good deal right now, and that exchanging debt for equity is a financially efficient way to reduce their debt load. It can also make their balance sheet look stronger by lowering their liabilities. On the other hand, issuing shares dilutes the ownership for existing shareholders, meaning each share represents a smaller piece of the company going forward. The amount of shares here, over 4 million, while not massive for a company like Seagate, is still a notable chunk. Their stock, the STEX ticker on the Nasdaq, is what investors are looking at. This type of maneuver, swapping debt for equity, isn't uncommon, but the specifics always matter. Why did they choose this moment? Are they concerned about their ability to pay back this debt later? Or do they genuinely feel their stock is undervalued? And this is a smart financial play. The filing states this was done as a private placement under Section 4, at 2 of the Securities Act. This means it was an offering not involving a public offering, which is pretty standard for these kinds of negotiated exchanges with large debt holders. So let's put this in perspective. Seagate has been around for a while, a major player in data storage. They compete with companies like Western Digital. In a market that is always changing with the rise of solid-state drives and cloud storage, managing their complex debt structure and optimizing their capital is crucial. This exchange is a strategic move, likely aimed at simplifying their financial obligations and possibly signaling confidence in their future performance, enough to use their own stock as currency. Now, looking at this a bit more broadly, Seagate is essentially making a bet. They are betting that the future value of their stock, combined with getting rid of that debt, is a better outcome than continuing to pay interest on those notes. They're also betting that their existing shareholders will be okay with a slight dilution of their ownership for the sake of a cleaner balance sheet. It is a complex financial dance, and the success of this move will ultimately be judged by how Seagate performs in the coming quarters and years. Did they get a good deal on buying back their debt? Will the cash and shares be enough to offset the future obligations or even improve their financial flexibility? Only time will tell. This filing, this 8K, is essentially a formal announcement of this completed transaction. It is not revealing new financials in terms of quarterly earnings, but it is detailing a significant change in the company's capital structure. It's a move that directly impacts their debt levels and their share count, both things that investors pay close attention to. When you see a company do this, it is worth digging into their overall financial health and their strategic outlook. So, what is my take on this? Seagate is actively managing its financial structure, which is a sign of a company that is engaged and trying to optimize its operations. The exchange of debt for equity is a classic financial engineering tool. If their business continues to grow and generate strong cash flow, this move could indeed be a net positive, reducing their risk profile. However, the primary risk is always execution. Can they continue to innovate and deliver in the competitive storage market? If not, even a cleaner balance sheet won't save them. The opportunity here is to emerge with a stronger, more flexible financial foundation, potentially freeing up resources for investment or returning more capital to shareholders down the line if things go well. The conclusion is that this is a carefully calculated move designed to improve their financial footing, but its ultimate success hinges on their business performance. Alright, that is our breakdown of this Seagate filing. What is your take on these numbers and what they signal for the company's future? Do you think this debt for equity swap was a smart move? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description below. Thanks for watching. See you next time.